Greetings from all of us here at Wespath. We hope you are enjoying your summer and thank you for joining us today. My name is Joe Halwax, Managing Director of Wespath's Institutional Investment Services team. I'm here at Wespath's offices in Glenview, Illinois, bringing you our second quarter 2023 Wespath update. The second quarter was an economic mixed bag. We saw cooling inflation, yet persistently strong labor markets. Equity markets were up almost 9% on the quarter, even as the yield curve became more inverted, suggesting a recession is still a possibility. Residential housing prices remain elevated, but serious questions remain regarding commercial property, particularly in large urban areas. Like I said, it's a mixed bag. With this lack of clarity, the Fed's task of reducing inflation without causing a recession grows increasingly difficult, and it may have to make an unpopular decision to keep interest rates higher for longer than investors would like. I'll offer more on these themes in a market update shortly. But first, let's start with a quick organizational update. The second quarter brought some great staff-related news for Wespath. Lucas Schopner joined our investment division as our Sustainable Investment Stewardship Manager, and Connie Christian has returned to Wespath as our Fixed Income Manager. Additionally, we announced the exciting news that Johara Farhadieh is joining us as the Deputy Chief Investment Officer and successor to Dave Zellner, who plans to retire next summer. I look forward to Johara's contributions and having her join us in future webinars. Also, July marks the release of our 2021 to 2022 Sustainable Investment Report. The report provides an overview of Wespath's organization-wide approach to sustainable investment and shares highlights from 2021 and 2022. In it, you'll read about our latest work on climate action, response to the opioid epidemic, engagements on human rights, recent positive social purpose lending investments, and more. Be sure to follow us on social media as we highlight our partners, stories, and sustainable investment milestones in coming weeks. Now, for what's to come. Today, my colleague Karen Manczko will review the performance of our funds, Jake Barnett will discuss the latest news in sustainable investment, and Dave Zellner will close it out with an economic update. We remind viewers that all these segments are available individually on our website. Thank you for joining, and let's get started. The theme in recent quarters has been mixed signals, and the second quarter continued to that trend. In the news, regional bank concerns remained, but appear to be contained for now, while the debt ceiling deal in May removed one of the year's greatest concerns. In the economic data, inflation, while cooling, is still higher than expected, leading the Fed to signal one or two additional rate hikes before this cycle peaks. Meanwhile, spending and employment remain strong, but consumer sentiment is poor. In theory, people should be happier about current economic conditions, but they're not. In the bigger picture, changes resulting from the pandemic, such as a sharp increase in the amount of hybrid or fully remote work, has affected our daily lives and the economy. And as a result, historical context has been much less useful for the markets and the economy. This makes forecasting even more difficult than it normally is. All this has led to some interesting times for financial markets. Let's start with a look at U.S. equities. U.S. equities rallied 8.7% on the quarter and are now up by 17% on the year. Taking a deeper look, we have very narrow leadership in U.S. stocks, with 7 stocks producing the majority of the broad index gains. Most of these names are large technology firms that will benefit from the rapid adoption of artificial intelligence or AI. By now, you've probably heard about all the AI buzz. Maybe you're like me and started to play around with ChatGPT. Maybe you're excited about the potential for self-driving cars. Whatever the use case, the market also appears to be very excited about AI, and for good reason. Looking at historical tech adoption and the race to 1 million users, for Facebook, it took 10 months. Spotify took 5 months. And ChatGPT took just 8 days. While there's a lot of hype around AI, it's hard to argue with numbers like this. I will discuss more about AI and its impact later in the webinar with Dave. It's also worth noting that in the US, the dominance of growth stocks over value stocks in 2023. Zooming out a bit, the Russell 1000 Growth Index has risen by 29% in 2023, significantly outpacing the Russell 1000 Value Index at 5%. This is notable because growth stocks historically benefit from a lower rate environment. But we haven't had a lower rate environment, so past norms are not reflected by today in stock performance. Let's look now closer at international stocks. International equities were slightly behind US stocks, with the MSCI EAFE index up 3% in Q2 and the MSCI Emerging Markets Index up 1.6%. Specific international indexes are very mixed, with positive examples like Japan, with the stock market at a 33-year high. They're benefiting from ultra-loose monetary policy. Or Mexico, which is up 25% year to date, buoyed by the potential for expanded trade with the US amid the themes of companies reshoring manufacturing to this country. Compare that with China, down 7% in Q2 and 6% year to date as the economy remains soft despite reopening. Let's look now at a slide from our friends at JP Morgan that looks at both earnings trends and valuations at international companies. On the right, we can see valuations. International stocks remain cheap compared to the US when looking at the price to earnings ratio. Europe is at 12.5 times earnings, while emerging markets are about the same, and China is even lower at 10 times earnings. All of these look attractive compared to US stocks at 19 times. On the left, we see the growth of earnings. In the era since the Great Financial Crisis, we've had loose monetary policy and low inflation, with the US and its exposure to growth companies as the main beneficiary. Now that the easy money era is over, we should see a return to more even levels of earnings growth, which is supportive of international markets. You can see that to the left of the gray bar, which was the GFC. Before we talk about bond returns, let's look at the US yield curve. The green line is 1 year ago, when we had lower and a normal curve, with yields lower in short dates and higher in longer maturities. The blue line is 3 months ago, the end of Q1 that reflects a sharply higher yield curve, especially at the front end after 5% of rate hikes from the Fed. Looking at the yellow line, that's the end of Q2, showing that yields have pushed higher as inflation remains sticky and as Fed officials continue to manage expectations for higher rates for longer than previously priced in. Now let's look at bond performance. With the uptick in yields, the US bond market was lower by about 1% on the quarter. For the year, bonds are up about 2%, more in line with historical returns after a difficult 2022. Meanwhile, commodities have fallen so far this year as inflation cools. The Bloomberg Commodity Index was down by 3% on the quarter, driven by a 3.5% decline in oil, and has continued to decline since peaking with a 26% return in Q1 of 2022. Our colleague Andrew Steedman recently wrote about what caused the commodity spike last year and why the asset class is down in 2023. Check out his blog on our website. On a final note, this historical chart is returns of a 60-40 portfolio. Without digging too deep, the longer-term perspective reminds us that in years following a sharp move lower in a balanced portfolio, returns in subsequent years tend to be positive. So while signals are mixed, and as we continue to adjust to whatever this new normal is going to be, it should not really be surprising to have positive markets this year. I'm joined by my colleague Karen Manczko, who will provide the update for the Wespath fund performance. Karen, thank you for being here.
Thanks, Joe, and greetings to everyone from Glenview, Illinois.
I've mentioned that the markets and economic signals were mixed in the second quarter. Would you say the same?
Definitely. I know that you and Dave explored the headlines in detail, but I saw softer inflation numbers in May, and therefore the Fed took a rate hike pause in June. Still, consumer spending has been resilient, and the economy continues to add jobs. With all this in the background, the U.S. equity markets were up 8% in the quarter, and international markets were up over 2%.
So given the positive equity markets, how did the Wespath equity funds perform?
You can see that the Wespath equity funds ended the quarter in positive territory, with both the U.S. and international equity fund composites up 7.4% and 1.8% net of all fees. The positive absolute performance reflects the strong overall U.S. equity market I just mentioned. However, on a relative basis, the composites did underperform their respective benchmarks by a little more than 61 basis points and 96 basis points, respectively. I'll review the specific contributors and detractors to our quarterly fund performance in a moment.
All right, so positive absolute performance in equities, but it looks like the fixed income assets were down for the quarter, which I assume is where your mixed results comment comes in.
Exactly. The stock market showed much more optimism than the bond market this quarter. What primarily impacted the bond market is that we saw the yield curve shift higher the last few months. As our viewers are aware, when yields go up, the price of bonds go down. Therefore, with the uptick in the yield curve, we saw the US bond market down about 1%. On the positive side, despite the overall bond market being down in the quarter, you can see on the chart that our fixed income fund composite ended the quarter up 2 basis points. Meanwhile, the inflation protection fund composite ended the second quarter modestly negative, but did outperform on a relative basis. So all in all, the fixed income side, both composites outperformed their respective benchmarks by 59 basis points to 126 basis points net of all fees.
Thanks, Karen. Before you talk about the specific contributors and detractors, let's get a sense of how we did compared to the rest of the industry. Can you tell us how the multiple asset fund compared relative to other balanced funds?
Sure thing. This chart showcases the multiple asset fund composite versus a universe of balanced funds. This slide measures how our balanced fund composite performed relative to other balanced portfolios and funds that are currently on the market. Looking at the chart, you can see that the multiple asset fund composite has performed in line or above the median across all time periods. For instance, for the 10-year time horizon, the multiple asset fund composite outperformed 60% of its peers.
Great, thanks for that, Karen. It's always good to check in on how we stand up against versus our peers. Now let's talk about those contributors and detractors. Can you break down what hurt and helped the funds in the second quarter?
On a gross of fees basis, the multiple asset fund outperformed by 7 basis points in the second quarter. The contributor to the gross of fee relative performance was the outperformance of the fixed income fund and inflation protection fund. On the other hand, the equity funds detracted from relative performance due to the underperformance I mentioned earlier.
Thank you, Karen. So we had sluggish performance from the fixed income funds on an absolute basis, but those outperformed on a relative basis. And the equity funds were up but underperformed their benchmarks. Can you dig into that a little more?
Yeah, sounds good, Joe. Starting with the US equity fund, this fund underperformed its benchmark by 44 basis points for the quarter. Starting with a review regarding what contributed to the performance. First, strong stock selection by our active managers. In technology, healthcare, and industrials contributed to the performance. Our investment managers' investments in companies like Supermicro, which is an IT solution provider that designs and builds environmentally friendly and energy-saving portfolio of servers and storage systems, was up 134% in the second quarter. Another example of a company that did well is Intuitive Surgical. This stock returned 34% and is a company that creates robotic-assisted surgical systems. Lastly, excluding tobacco and defense companies was a contributor for the quarter.
In my market update, I discussed the impact of the Super 7, or large technology companies that accounted for most of the gains in the U.S. stock market year to date. How much of the U.S. equity fund is invested in these names, and what impact did it have on the fund's performance?
Interesting timing with that question, Joe, as I was just getting ready to review the other side of the slide, which are the detractors. Yes, 7 stocks accounted for 65% of the total market return. These names are Apple, Microsoft, Alphabet, Amazon, Nvidia, Tesla, and Meta. Names that we continue to hear over and over. We are invested in these names, but the weighting in our fund in these stocks is less than the benchmark. And this is primarily where that mega cap stock underweight comes into play. And the impact it had on the performance, being underweight these names, was a detractor. Some of these 7 stocks returned 190% and 138%. And I know some watching may be asking themselves, why did these names do so well this quarter? Well, they did well for varying reasons, including customer satisfaction, as in the case for Apple and Tesla, or an expansion into AI technology. It is worth noting that the large cap stocks outside of these mega cap names actually underperformed our fund's benchmark in the Russell 3000. So if we take all of the large cap stocks and remove those mega caps I just mentioned, the fund's large cap underweight was actually a contributor to performance.
Karen, AI was definitely a prominent economic factor at the moment. It's something that I mentioned in my market update and we'll be discussing with Dave later in this webinar. So it's certainly on people's minds. Are there any other comments on the U.S. equity fund before we move on?
I have a few final comments. The fund's modest allocation to private equity and private real estate also detracted due to the strong U.S. public market, and these strategies not being able to keep pace due to their lag. Finally, the fund's underweight to small and mid-cap stocks detracted as they underperformed the mega-cap stocks that I highlighted a moment ago.
You mentioned that the International Equity Fund underperformed the benchmark for the quarter. What were the drivers of the International Equity Fund's relative performance?
The International Equity Fund underperformed by 40 basis points. And the primary reason for the underperformance was stock selection by our fund's active managers, particularly in consumer discretionary, healthcare, industrials, and materials. An example is the online retailer Zalando, which was down 30%.
Great, thanks for highlighting that. Now let's talk about bonds and the two fixed income funds and how they performed on the quarter.
The fixed income fund outperformed by 77 basis points for the second quarter. This was a risk-on quarter, meaning investors were more interested in the riskier corners of the market. Therefore, the fund's allocation to emerging market debt and manager issue selection in that style contributed positively, along with the manager's allocation to high-yield bonds coupled with that manager's issue selection too. Finally, the fund's Core Plus manager PIMCO also had strong issue selection, particularly being underweight UK bonds and overweight credit as we saw spreads tighten during the quarter.
Any detractors to the fund worth commenting on?
What detracted from the fund's performance was the global bond manager's issue selection. The manager was overweight the short end of the yield curve, and we saw rates rise, which impacted bonds negatively.
And then what affected our final fund to talk about today, the Inflation Protection Fund?
The Inflation Protection Fund outperformed by 143 basis points for the quarter. The fund's overweight allocation to global and emerging market inflation-linked bonds contributed, along with the fund's allocation to floating rate senior secured loans, as we saw rates rise during the quarter.
So Karen, thank you for that performance summary. We appreciate your time.
Thanks, Joe.
So Jake, I know that the second quarter is a busy time for the stewardship team, as most of the annual general meetings for companies in US and Europe occur around this time. Can you give us a brief description of what you all are doing in terms of the relation to these meetings?
Sure, Joe. So most publicly listed companies in our portfolio put several items up for a vote at their annual general meeting. Common items of governance include approval of directors, executive compensation plans, and approval of auditors. Other items can be put on the ballot through shareholder proposals. These can either be related to core governance topics, like whether the CEO and chair role should be separated, or specific environmental and social issues that the filer of the proposal feels is material to the company's long-term success. Our team oversees how Wespath votes these proxies in a couple of different ways. The first is through manually voting some of our top holdings, where we read the proxy statement, do third-party research, and discuss internally what vote decision aligns with our fiduciary obligations. For those companies we don't manually vote, we oversee the implementation of custom guidelines through a service provider.
Great, thanks for that explanation, Jake. Given the work you described above, what were some of the broader trends that you saw this proxy season?
One of the key trends we're seeing on this slide, Joe, is lower support across all proposal types. For the last several years, prior to 2022, we were seeing an increasing trend of support for shareholder proposals. However, this year we saw a drop in support for proposals ranging from executive compensation to human capital management.
And what do you think is driving that decline?
There are a few reasons we see commonly cited in the marketplace. One is that large institutional investors are criticizing many proposals for being too prescriptive, meaning that the proposal is too explicit and specific in laying out the action that the investor feels a company should take. Often, large investors prefer to leave questions around specific implementation to the company management or board. However, a recent SEC rule change allowing a broader array of proposals to be filed allowed for more specificity. Some investors think that has led to poorer quality proposals that are more difficult to support. Another reason is that some of the low-hanging fruit proposal targets have largely been covered in previous years, in those trending up support years. For example, with the success of proposals asking for companies to publish basic information on how they are managing climate risk, Most companies have adopted some form of disclosure, either through the prompting of a proposal or proactively after recognizing that this was an area of interest for many investors. Finally, a large part of the pullback can also be prescribed to a greater level of discernment being applied by large asset managers who drive large percentage of votes at companies. As these asset managers have come under increasing pressure and scrutiny from anti-ESG proponents, it has likely caused them to take a closer look at proposals they may have supported in the past. On the next slide, you also see some of these managers indicating a preference for voting against directors rather than for proposals. It is too early to tell what the impact of this increasing focus on director votes for asset managers will be, but this is a development we are interested in watching and are actively engaging our asset managers on.
And what specific Wespath focus areas or lessons learned are you seeing from this season, Jake?
Well, Joe, to stay on the topic of director accountability for votes, we did pre-declare that we would be voting against 2 directors at Chevron this year. The reason is that these 2 directors were responsible for oversight on how the company aligns their stated commitments on climate with their lobbying and public discourse. We had concerns about the alignment that we brought to the company through private engagement channels. However, we did not see meaningful progress from these conversations, so we decided to take the next step of elevating our concern to a public declaration that we would then share with the broader investor community. While we did not see major swings in support for these 2 directors for this year, we're looking forward to learning from the asset manager and peer investment community how they responded and evaluated this idea. We want to understand more about what investors look at when determining whether to support directors using this example as a specific case study for discussion. We are confident these learnings will help us be more effective in making our case in any similar action down the road.
So besides climate, what were the other areas of focus in this proxy season?
Many viewers have likely heard about our work on opioid accountability. The opioid epidemic remains a key concern for us at Wespath as an obstacle to our goal for helping to support long-term prosperity for all, one of the key pillars of our sustainable economy framework. You can see on this slide some of the economic impacts of this epidemic, with the tragic truth being that the trend lines that we have seen for overdoses cited here for 2020 have shown a significant increase in the last several years. This focus on opioids led us to taking on the co-lead role of the Investors for Opioid and Pharmaceutical Accountability, or IOPA. The IOPA is an investor coalition representing more than $4 trillion in assets under management, focused on engaging and amplifying areas of concern for investors in the pharmaceutical sector through engagement. This proxy season, the IOPA focused on what at first glance seems like a rather dull issue: how companies calculate executive compensation. The reason for this focus is that the IOPA saw many pharma companies excluding hefty legal settlements and fines related to the opioid crisis from their calculations for executive compensation. The IOPA did not believe this practice was aligned with investors' economic interests, since executives were not properly incentivized to avoid mismanagement related to opioid or other regulatory risks, nor did it align with what Wespath sees as the sustainable economy framework long-term best practice. Through this focus, and despite some of the headwinds ESG proposals were facing this year, the IOPA was able to negotiate withdrawals of the proposals at 5 of 6 companies.
And to clarify, a withdrawal proposal is usually considered a positive development?
Yeah, Joe. Investors will often withdraw their proposals if companies commit to making progress on the issue. This indicates that the company is receptive to the engagement and has indicated that they'll take some kind of action.
That's a great story to end on, Jake. Thank you for being here today, and we look forward to talking next quarter.
Thanks, Joe.
Thanks, Dave, for joining our quarterly webinar. Let's start out by discussing the state of the U.S. economy in the absence of that long-awaited recession. What is your reaction to the strength of the U.S. economy so far this year, and how do you see the rest of the year playing out?
Thanks, Joe. You're correct that the economy has demonstrated continued resilience in the face of the doom and gloom predicted by most economists at the beginning of the year. So let's start by revisiting what economists predicted for U.S. growth just 6 months ago. The chart on the left shows how economists' prediction for the U.S. economic growth in 23 evolved over the last year. At the beginning of 2022, the more than 60 economists surveyed by the Wall Street Journal thought the U.S. economy would continue to show real economic growth at better than 2% coming into 2023. But then inflation continued to climb, peaking at over 9% in June, and the Federal Reserve turned more aggressive in raising interest rates to fight inflation. So as a result, economists' expectations deteriorated. At the beginning of this year, those same economists believed that the U.S. real economic growth would only be plus 0.2%. The table on the right breaks down their 2023 forecasts for each quarter. In January, economists predicted that the economy would be essentially flat, yet the U.S. economy continued to grow at 2%. For the second quarter, they initially thought GDP would be negative and then changed their growth forecast to 0.1%. However, it looks like once again, the economy may have grown by 2%.
So Dave, why did they get it so wrong?
I think it's fair to say, Joe, that few thought consumer spending would remain as strong as it has. Let's look at what makes up the U.S. economy and how each component contributed to first quarter growth. On the left, we see that consumer spending, officially called personal consumption expenditures, accounted for 68% of the U.S. economy in the first quarter. Government spending accounted for just under 18%. Business investment made up 17%, but then we have to subtract 3% because we import more than we export.
So wait a minute, on the net imports topic, so why do we have to subtract net imports?
Because, Joe, GDP measures the values of goods and services consumed in the United States economy. Anything that we consume made outside the United States is included in the GDP of countries we bought it from. Now, we do include the value of exports, but the U.S. has long imported more than it exports.
All right, that makes sense.
So if we look at the chart on the right, consumer spending grew 2.8% during the first quarter. About half of that came from durable goods purchases. The auto industry experienced better than expected sales during the first half of the year, largely because of pent-up demand for new cars resulting from the shortages that came out of the pandemic. Consumers also spent more than expected on furniture and recreational goods, such as boats and all-terrain vehicles. This was somewhat unexpected given the rise in interest rates. The other half was growth in services such as airline fares, hotels, and restaurants. We did see a noticeable decline in business investment, which really isn't surprising as it was a response to the forecast from economists that there was going to be a recession.
So Dave, you said in the second quarter, growth is also going to come in at 2%. Can we assume that consumer spending is the main contributor?
From the forecasts I've seen show, consumer spending was not as strong in the second quarter as it was in the first, but there appears to be positive growth in business investment, again in response to stronger than expected consumer spending, as well as a buildup in inventories.
So Dave, what about the rest of the year? Are we finally going to see that recession?
It's hard to say, Joe. As we see on the left side of this next chart, consumer confidence has bounced off of its low from a year ago, but it's still meaningfully lower than it was pre-pandemic. So while not a level that we would like to see, consumer confidence does seem to be improving. But if we look at the right side, purchasing managers for manufacturing companies continue to paint a pretty bleak picture, with 56% of respondents saying that business conditions at the end of June were worse than the month before. Now, conditions for the service sector are positive. So, as you said at the beginning of your earlier remarks, Joe, it's a mixed bag. But ultimately, we must pay close attention to Chair Powell and the Federal Reserve. They've been quite emphatic in their position that inflation remains too high relative to the 2% target. True, Headline CPI has come down from over 9% to 3% at the end of June. However, the Fed's preferred measure, known as the Core Personal Consumption Expenditures Price Index, remains elevated at 4.6% for the month ending in May, as you can see on the chart on the right. And as you stated earlier, Joe, 2 more rate hikes this year are certainly a possibility. Hence, I believe that we are in the cusp of an economic slowdown. I can't say that a severe recession is inevitable, but there are several signs pointing to a decline in consumer spending. We've seen consumer savings rates increase, and we've also seen high consumer credit default rates. In addition, the student loan holiday will be ending in September, and that will certainly put a dent into spending.
So what does that mean for the markets, Dave? Has the market gotten ahead of its skis in the first half of the year?
I would not go that far, Joe. Everything I've said up to this point is widely known, and I believe reflected in current market prices. Let's not forget, the market began anticipating a recession in 2022. And despite the performance in the market so far this year, we still have not made up for the losses in 2022. So let's first look at this next chart. It displays some of the same data you showed earlier. The S&P 500 was up nearly 17% in the first half of the year, though heavily skewed by the artificial intelligence technology stocks that you mentioned earlier. Some of us have referred to this group of stocks as the Super 7. Collectively, they gained nearly 61%, meaning that the rest of the U.S. stock market only gained about 6%. Developed country stocks performed quite well, up nearly 12%, while emerging market stocks gained about 5%. But now look what happens when we look at the next chart, when we combine returns in the first half of the year with 2022 returns. All markets remain underwater compared to how they ended 2021.
That's a really interesting point, Dave. But what about corporate profits? Aren't they still in the proverbial tank?
That's a good point, Joe. Yes, the outlook for near-term corporate profits is rather anemic. Profits declined in the fourth quarter of 2022 and just barely achieved growth in the first quarter of this year. And the outlook for the second quarter is for a profit decline of about 6%. Expectations for the third quarter aren't all that rosy either. But again, the markets know all this. Stock prices very likely reflect a poor corporate profit outlook and the potential for a near-term recession. Future gains or losses in stocks will depend on how severe and how long the market ultimately expects the recession will last. So back to your original question, Joe. No, I don't believe the market has gotten ahead of its skis.
So let's pause here and talk about what's driven prices for the Super 7 that you mentioned. You've been a big fan of ChatGPT. I've also integrated it into my arsenal of professional tools, use it as a brainstorming tool as well. Research shows that artificial intelligence, or AI, right now is a $100 billion industry that could grow to $2 trillion plus by 2030. Is AI the phenomenon that we're hearing about, or a passing fad, or a game changer?
I definitely think it's a game changer, Joe. And I think so in a big way. Just like the internet was 25 years ago. I think all of us that were using the internet thought it would be life-changing, but we just couldn't quite imagine exactly how. Now, fast forward to 2023, and no question that the internet has drastically changed our day-to-day lives. From how we get our news, to how we shop, to how we are entertained, to how we interact with others. Life isn't the same as it was 25 years ago. Now, while I can't today say exactly how AI will change our lives, I do believe that 25 years from now, we are going to have experienced another major life-changing transformation. This chart showing now touches on some of the applications that we can expect AI to deliver in the future. I sure saved a lot of time identifying the applications for AI in the slide. I simply asked ChatGPT to identify practical AI applications, and what appears is the response I received from the chatbot. Now, we prepared the slide, but I can imagine a few years from now, I could just say, create a PowerPoint slide with 10 AI applications, and I would have had the same slide pop up.
So I agree, Dave. And AI is in its infancy in many ways. It's certainly going to be interesting to see how this technology continues to develop and integrate into our lives. So finally, what do you see in international markets? As we both discussed, the developed markets turned in some decent performance in the first quarter. While the emerging markets were positive, they continue to lag the US and developed markets. How have the international markets performed this year, and what are your thoughts about international economies for the rest of the year and in 2024?
Well, Joe, so far this year, the international markets have been, well, a mixed bag. Developed stock markets in France, Germany, Holland, Italy, Japan, and Ireland all produced double-digit returns, with half the countries that I mentioned beating the US stock market returns. In emerging markets, Latin America produced strong returns, though a significant portion of the return is due to strength in Latin American currencies relative to the US dollar. Latin American central banks have aggressively pushed up rates to fight inflation, which has positively influenced currency flows to those countries. However, China continues to disappoint. Expectations were high going into 2023 due to a lifting of the COVID restrictions. Last week, Bloomberg reported that China is facing a continuation of its problems: sluggish consumer spending, a crisis-ridden property market, declining exports, record youth unemployment, and elevated levels of local government debt.
So let's pause a second here, Dave, because China is a topic that we frequently discuss with clients. The Chinese market, and to an extent its economy, have been in the doldrums for the past several years. And as you said, the economy is facing several economic headwinds. Add to that concerns about human rights violations in China and an invasion potentially of Taiwan. How confident are you that China remains a viable source of investment returns in the future?
So those are all good points, Joe. Chinese stocks have not produced anywhere near satisfactory results over the past several years. We do maintain frequent contact with our asset managers that invest in Chinese stocks, and they collectively maintain high conviction regarding the specific companies that they hold in their portfolios. Now, I should mention that Chinese stock valuations on both a price earnings and a dividend yield basis are really quite attractive. So, Joe, I'm still not ready to throw in the towel yet on China.
Okay, Dave, understood. So what is the outlook for the remainder of the year?
So Europe and especially the UK continue to struggle with inflation, and their central banks remain steadfast in aggressively administering monetary policies to bring inflation down. Hence, the situation in Europe is like the US, with many waiting for what they believe is that inevitable recession. So let's take a look at the purchasing manager surveys for Europe and the emerging countries. As you can see, current conditions in Europe are like the US, and the worst they've been over the past year and a half. Conditions are a bit better among emerging countries, with India being a strong standout. As we see on this next chart, and once again, like the US, services seem to be in a fairly decent shape, except for possibly France, which has been affected by domestic unrest over the past week or so. So to summarize, the rest of the world seems to be in a state like the US, waiting nervously to see how deep and how long the inevitable recession is going to last.
Great, thanks, Dave. It's certainly going to be interesting to see how the US and the world economies evolve over the next several months.
Thanks, Joe. And once again, I've enjoyed sharing my thoughts with our viewers.
Thank you for joining us today. If you have any questions, please email us at investmentinfo@wespath.org. We'll see you again next quarter.